In 1970, average public university tuition was roughly $394 a year. A student working a minimum wage summer job could clock 480 hours at $1.60 an hour, earn enough to pay their tuition in full, and still have cash left over. Fast forward to today. To achieve that exact same outcome for an average private school on a minimum wage job, a student would have to work 100 hours a week, 52 weeks a year. There is no math that makes that possible. The result is 42.8 million Americans currently sitting under nearly $1.7 trillion in federal student loan debt. When the cost of an education outpaces wages by this much, the traditional path of working your way through school becomes a mathematical impossibility for most of the country. For 5 years, starting in 2020, the government paused federal student loan payments. 42 million people temporarily stopped writing checks. Then, in 2025, the pause officially ended, and the bills came due. This chart tracks the student loan delinquency rate. Notice how from 2020 through late 2024, the rate sits flat, hovering at barely 0.5%. But right here, in 2025, the line violently spikes to nearly 10% in a single year. That spike represents 7.9 million people missing payments in just 9 months, and falling into delinquency crushes credit scores by an average of 57 points, with 2 million borrowers plunging a full 100 points straight into deep subprime territory. Suddenly, leasing a car costs 28% more, and access to conventional mortgages vanishes entirely. This financial damage is highly durable. A single missed student loan payment is anchored to a credit report for 7 years. The payment pause functioned as a temporary shield, leaving the underlying debt untouched until it finally collided with the financial reality of 2025. To trace the origin of this debt, we look back to 1965. Congress passed the Higher Education Act to guarantee student loans, with the straightforward goal of making college accessible to anyone. Once the government guaranteed the funds, borrowing surged. In 1966, American students took out a combined $73 million in loans. Just 15 years later, that figure had exploded to $7.8 billion. Then the political strategy shifted. In the 1980s, states passed strict spending limits, heavily slashing the tax subsidies and funding previously provided to public universities. Facing immediate budget shortfalls, universities had to make up the lost revenue. They responded by aggressively hiking their tuition rates. The massive financial weight of higher education was officially transferred away from the government and placed securely onto the shoulders of 18-year-olds. This new environment created a highly lucrative conflict of interest. Some of the most elite universities in America became early investors in the major student loan company, Sallie Mae. This self-enriching loop. Universities raised tuition. Students borrowed from Sallie Mae. Sallie Mae collected interest. Its stock climbed, paying dividends back to the universities. Comparing trend lines since 1980, inflation is clear. Tuition surged 169%. Young workers' pay crept up just 19%. At the same time, for-profit colleges spotted a vulnerability in the system. They actively targeted low-income students, veterans, and first-generation applicants, securing massive federal loans in exchange for degrees that frequently offered zero value in the job market. Higher education effectively stopped functioning primarily as a public good. It evolved into an extractive business model engineered to maximize institutional profit. This system does not impact everyone equally. Black Americans carry the highest median student loan debt in the country, and today, nearly 50% of Black and Native American borrowers are behind on their payments. The sheer gravity of this debt forces millions to delay their lives. 21% of borrowers put off getting married, 26% delay having children, and over a third push back buying a home because of the loans they signed at 18. This reality has ignited a bitter national debate over loan forgiveness. One side argues that because the system itself was rigged by predatory pricing, blanket cancellation is the only moral fix. The counter-argument asks if it is fair to transfer $1.7 trillion onto taxpayers, including those who chose not to go to college, while failing to address the universities that caused the runaway costs. Regardless of your stance on cancellation, the economic data is clear. The sheer weight of this debt load is stalling the American middle-class life cycle. If you hold student debt right now, you need a defensive strategy. Log in to studentaid.gov and audit exactly what you owe. Then check if you qualify for an income-driven repayment plan, which legally caps your monthly payment at a manageable percentage of your income. Next, investigate public service loan forgiveness. If you spend 10 years working for a government agency, a public school, or a nonprofit, you can have your remaining balance entirely erased. To actually fix the system, we need legislative guardrails. The government must cap exorbitant interest rates on educational debt, and colleges must be forced to have skin in the game, meaning if their graduates consistently default on their loans, the university shares the financial penalty. For incoming students, you have to treat higher education like a massive financial transaction. Calculate the strict return on investment for your chosen degree before you sign the master promissory note. This crisis is the result of decades of policy decisions that shifted the cost of education onto the individuals least able to afford it. Fixing it requires legislative accountability, radical transparency, and an honest reassessment of what the American dream actually costs.